Global markets really started the quarter by continuing on their strong performance. And then we hit the middle of May. Now what happened in the middle of May is essentially the Federal Reserve in the US came out and said, we're going to start easing off on a lot of the quantitative easings that basically came through into markets. So the markets really had a negative reaction to this, and rightly so, because this is the first time that central banks have basically said that they want to actually remove stimulus from the market. So markets obviously reacted negatively, and what we saw in May and June was a lot of payback for all the strength that we'd seen probably for the previous 12 months. Subsequent to that, markets have sort of since rallied back because, some of the economic numbers, ironically, haven't been all that great. But what that's meant is that maybe the actual Federal Reserve will keep that stimulus on for a little bit longer. And I think that that's been one of the key metrics to actually get to where the markets have performed over the course of the last 3 months. In Australia, we've obviously been affected by what's happening around the world, and our market sold off just as much as a lot of the overseas markets did. But contrary to that, if you had your money actually invested overseas, the fall in the Aussie dollar that eventuated as a result of this has actually protected a lot of our international investments. Now, as a result, we had the Aussie dollar that was trading between 102 and 106 against the US dollar for quite a period of time. What happened was we had a sudden sharp adjustment that basically saw the currency move down to about 92 cents to the US dollar. Now, that does sound extreme, and it was extreme within the course of a month and a half. But the effect that it actually had on overseas assets and the value of those overseas assets meant that investors actually saw returns in the order of about 15%. So that did help to buffer a lot of the returns, and particularly when we're starting to think about where our super is invested and the degree of hedging that we had in our portfolio. So we had taken a lot of that hedging off at 106 and basically saw the real buffering effects that the currency could give our investment portfolio. In terms of taking advantage of these conditions, what it does do is it creates the volatility, it creates the uncertainty in the marketplace. That's exactly what we want, all right? So it's really trying to get to a point where, if the market comes off, we can buy a little bit in. If the market rallies up more aggressively, we can actually start to take risk off the table. That's what it's all about. That's the environment that we're in, and it's the environment we continue to be in. We're going to take advantage of that by just basically trading around the edges. There is obviously the long-term objectives that we need to be invested in the marketplace. We are never going to take risk completely off the table, and we are never going to put risk on to the point that we're looking for a cowboy type outcome. This is all about risk management, but it's also about taking the opportunities when they present themselves. Key global risks that we're monitoring at the moment, very much around the geopolitical sense. There is still a lot of turmoil in the Middle East, political indecision that we're basically facing in the US. There is an election in Australia, and we still don't know a lot of the different policies that are going to come about as a result of that. What does that do? It creates uncertainty. Now, if you're an investor or if you're a CEO of a company, it's going to be difficult for you to basically take a long-term view in terms of the prospect of investing for your company's future in an environment that is so uncertain. And that then translates into investor uncertainty. And that's what we've got to manage. The other thing to manage is obviously whether or not the Federal Reserve does start to taper off, and you do start to see an impact from a lot of the central bank stimulus that's been pumped into the economy start to actually ease up a little bit. But don't get me wrong, rates are still going to be very supportive for the economy, and that's the important point to take out of this. But we also have to acknowledge the fact that the markets will react to anything that the central banks around the world do in relation to start to ease that sort of situation back again, back to more normal levels.